question was about what's a bad high and what's a bad low. How do you identify them? What do you do with them? So we'll run you through very quickly a few different elements of bad highs, bad lows, and how they come about and what you want to be thinking when you're taking these trades on. So first up, how do you spot them? Essentially, bad high is quite simply multiple tests of the same level. Now I'm going to suggest that you want this to be on at least a 15-minute chart, but I'll give you an example of a 1-minute chart that gives you an execution opportunity, but that's within a larger context. But ideally a 15-minute chart. Perhaps the easiest way to see them though is if you have a market profile up. If you have a profile, your profile will have a flat top or a flat bottom, i.e. there has been no tail created. Now the lack of tail is an indication that the move is not over, and that's the way you always want to think about a poor high or a poor low, that the move's not finished, and so therefore we can go further, and that becomes then a target with the expectation that that's going to break and you're going to get this pop through the high or through the low, and then potential continuation. We'll come to that in a moment. So why do they get formed? Basically what happens, the way that these get formed is it's the forced halting of the auctioning process. So that sounds rather wordy. What I'm trying to say there is whenever you have a market trading, it will move up to a certain point and eventually you'll run out of buyers. Now to create a bad high, what happens is rather than you running out of buyers, instead you find a seller who is willing to sell at that price, and they will sell to everyone who comes in to buy. So effectively that seller's not recognizing the demand and raising their price and finding the last buyer. Instead, what they're doing is they're just stopping and saying, right, well, at anyone who comes up at this price, we will sell them. Likewise, fall to the low, and a buyer will say, right, anyone who wants to sell at this price, I will buy it from them. Rather than recognizing that loads of people are happy to sell there and dropping your prices. So effectively, someone has stopped the market going higher or lower, and the fact that it tests the same level over and over suggests that there are more buyers or more sellers there, because otherwise it would hit the level, find a seller, let's say at a bad high, and just move away. But the fact that it keeps going back there suggests there are still buyers. What you'll typically see is a kind of constant reloading as well. So you'll reach the level, let's just say it's a high, you'll reach the level, you'll hit it, and someone will come back and sell and sell and sell and sell. And what that's doing is, again, that's just absorbing all that buying. So this then gives you a point where you can say, okay, I've got a trade here. The difficulty with this trade though is that you have a target, you don't have an entry, and it's very difficult to define a stop, because when I say you've got a target, the target is the break of that level. Now it could break and charge through the level. It could also break, tick through the level and roll over. So your target is essentially the break of the level. Now you can add further context to that and decide if there's potentially more in it, but that's the main kind of target on the trade to start with. So what happens then? And you've got two scenarios. So don't just assume that whenever you see a bad high or a bad low that the market is going to go there and go through it. That's a little bit too simplistic, but on the whole, that's the concept and the idea of the trade. So what you're looking for is you're looking for the level to break. So you're aiming to see the people who were reloading and selling at that point disappear. They're no longer there. The buyers can keep on buying. And that will then progress the move higher. And typically this will start with a little pop up, and I'll show you an example of this in the S&P. Alternatively though, and this is what catches people out typically, The obvious trade is you play for the break. That seems pretty obvious. But what happens if the break doesn't come? And what will often happen is you'll get this sort of attempt to move higher, and as the market starts to roll over, more people will buy. Remember, you don't have an entry point as such, so people will try and accumulate position below the level with the expectation that we'll pop through it. So eventually you've got this weighting of positions expecting the level break. Now when that doesn't happen, market rolls away and you'll get this liquidation, so it'll kind of fall off a cliff. So don't just assume that every bad high or bad low breaks. You've also got the potential for trade in the other direction as well, and I'll go and explain those in due course. So we've got the identification. You understand why they've been formed, how you get to these bad highs and bad lows. Now, different market environments produce more of these. Slower, quieter markets, you'll typically get more bad highs and bad lows. Particularly notable at the moment in bunds, especially, you're seeing quite a few of them, and European equities to a degree. Markets have slowed down after the first couple of weeks of excitement of the year. So let's go first up, just a quick look, identification. So what I've got here is a 15-minute chart and a profile, and you can see how easy they are to spot on a profile. Flat topped profile, that's these highs up here. So multiple tests, and this gives you that flat top profile. That's a point you would expect to break. Likewise, a bad low can be created within the day. So on this day over here, so this was last Tuesday, we create this bad low at 14. Multiple tests of the same price, and within the day you get a break, and this is, like I say, is the problem or the danger with a bad high or bad low. That breaks, we break down to around about 10 and then reverse straight the way back up. So the key here was being able to find a position above the low so that you're short as you go through. Because if you sold it at the low, unless you were quick, you weren't really going to get out of that for a profit. Likewise, to the upside, bad high, break, can't sustain the move above, and then roll back down. What we've currently got, and this is still in play, the lows from Thursday last week. Multiple tests of the same low. This was post the ECB down at 176.75. This again has created a flat bottomed profile. This is a point that you would expect at some point we'll get back there and we'll break through it. So this then enables you to start thinking about trade. Of course, you can't really sell Bund now. Bund's currently trading 177.68 and is actually breaking through its highs of the day. So selling it effectively up here isn't really an option to trade down here. So what you're more thinking is at some point as we approach this level, you will get some kind of pattern to execute to be short as you reach the level with the expectation that you'll go through it. So that's the way you want to treat a bad high, bad low, that your assumption is next time we go there it will break, and therefore you need to find some kind of pattern that allows you to be short or long into that break. Therefore you're already in position when you go through, and if you've got that enables you to assess whether the move's continuing when you get a scenario like this. So where you break through, little drop through and doesn't keep going. If you're short from higher up, you can see that it's not continuing and you can give up the trade. Let's go and have a look a little bit more complex. Bad highs don't have to be on one day. So what we've got here is the S&P. This is from the very beginning of the year. This was the first day of the year, the big sell-off, and then we create multiple tests of that same level. It's around about 73.5. Also bear in mind that a bad high doesn't have to be precisely to the point, particularly in more volatile markets like S&P. But what you can see here is you've got this collection of highs. There's 2 touches over here. This is a half-an-hour chart. 2 touches over here, 3, nearly 4, 5, 6 touches. Multiple tests at the same point, bad high. On the profiles, this is what you see, and there's no tail. So really, technically, any market that doesn't have a tail on a profile is essentially a bad high. So your expectation then is when you get back up there, we're going to get there and break. Now, I talked about the idea of finding a pattern to get into the trade before it breaks, and there's no point in me going and showing you multiple different patterns. Essentially what you're looking for is some kind of continuation pattern. But what is really important is the order flow when you get there. How does the market break the level? So let's go and have a little look at this. Remember, the level here is around about 73.5 to 74.5. That's where you're looking for the break, and we're going to look at this move. Essentially what happens is, of course, it's been held there. Essentially someone lifts the ceiling, sort of opens the roof and lets the market float higher. A bit like cutting a string on a helium balloon. It's being held down, it's being held, release, and off it goes. So what we've got here then is, this is the 1 minute chart of the break. So this is when you broke through that level, so this bit here. And what you actually find is you create bad highs just before this. So the selling is still happening at 74 3/4 in this instance. And what we're going to have a look at is the actual break. So there's your 74 3/4. You can see that 1600 lots is already traded there, 600 at the 75s. So what you're looking for then is order flow that suggests that there's buying pressure coming in, and then when you get to 74 3/4, you want to see no reloading. If you see no reloading, that's then your chance to add into the level with the expectation that we're going to pop through. And this gives you a good example as well of the pop. So the actual jump through, which is something that you'd be looking for on a clean break of a poor high. So here we go, you're getting up towards the level, and you see here the move up 73 to 74, constant buying. You're not seeing a little bit of selling here at 73 3/4, and this is where you're getting the bulk of the volume. So you're thinking, right, well, get over this. As long as buying keeps coming in, 74 quarters, halves, then you're willing to go for it. You're willing to try and attack that level. So this is a method to try and execute without being pre-positioned. So you're waiting here and you're thinking, right, well, 73 3/4, that's gone. Trading 74. A little bit more trade into it, a little bit more trade. The bid keeps coming back. That's good news. So you can buy 74. 74.5 goes. Very nice, very easy. Trading 3/4. So now you start to see some reload. 1900 trades. There we go, we're through the level now. So you can look to buy, and you notice it's not backing off. 2,500 traded at 3/4 now. Trades back to half, and the buyers keep coming in. So this is looking alright now. Then you get the jump, and as soon as it's jumped, then you're happy on the trade. You can execute and exit as soon as it jumps up, and look for that, pop up. There you go, 2-3 handles, nice and quick. Execute and get out. Alternatively, if you think that there's more in this, then you can let the move go. You can keep on playing for the move. And you see here, out very quick for a couple of handles, this move's continued to surge, almost no pullback. And so the way you want to be looking at that, then, this is going to be a decision to be made looking at a wider context. How much further do you think you can go? Where's the next level? Asking yourself questions like that. So in this scenario, you don't have to just jump out really quick. It's a case of, well, at least give it that little moment to continue upwards. Of course, some of those are going to do that little jump up, and you'll be thinking, why didn't I take the 2 handles when they roll back down? But you've got to look at this and say to yourself, well, if I'm buying down here at 74, 74.5, jumps to 77. If this starts to stall and then starts to roll over again, then potentially you're wrong. You're still going to be able to get out for a small winner, but by not getting out on the jump, what you enable yourself to do is, if this continues in this fashion, you're in for the entirety. So use that jump. I've given you an example of where people can often make the quick mistake. It jumps, they get out. When it jumps, give it a moment to see if that buying pressure keeps coming. If it does, the move is good to keep on going. And there we go, and you see that it continues all the way up to 95 over the next 10 minutes. First fast jump up to 80, start to build some value around 80. The buying still keeps coming in. You've got 400 lot on the bid as well. So once you start pushing through 81, you can then look to try and continue the buying here. You still see a little bit of selling coming in at 81. This 200 goes, there's a chance to have another go at buying to keep the move going. And that would then be your chance to keep your position running and look to continue that move towards the upside. Right, I'll minimize that. Last bit then to look at, liquidation. So when you have a bad high, what you need to be thinking about is other people are going to see that bad high as well, and other people are going to be thinking, right, I want to get in so that I can play the break. I want to get long to play the break. And this can be quite short term, it can be a little bit longer term. So we'll look at two here. Bad high in gold, and that's this high up here. So we'll come back to this one in a moment. That's this high up here. That's the recent high from the bounce from the lows, so 1875, that came in last week as well. Now, when you get this bad high, on the back of a reasonably strong rally, what you'll get then is the rest of the day and the following day, people trying to accumulate position, particularly if it's above these highs here, trying to accumulate position to play for the break. That's what they're going to be looking for, thinking, right, break 74.7, continuation up. So what you end up with is a weight of positions up here, waiting for the break. Now, they're all going to have to give up somewhere. They can't just keep buying, hoping that this bad high breaks. So you will then get a point where they start to give up, and you actually get the opposite and the acceleration to the downside as the people building positions here liquidate the trade. Similar idea over here on a much shorter time frame. Trades up, creates a bad high, falls back down, and then as you start breaking through what at the time were the lows of the day, you then get this very fast drop. It's a liquidation. So with liquidations, you don't assume that they're just going to hold down. It could well be a case that you get this quick drop. If it doesn't materialize into anything more, then a steady reversal. Similar story here. Not quite as fast on the drop, doesn't continue the move down and rotates back up. So main thing to take away these bad highs and bad lows. First expectation is they will break. It's suggesting that the move has not finished. That's important. So whether that move is not finished and we bounced away like we have in the Bund, that trade is still going to be there one day. It may be next week, it may be next month, but those breaks of lows are still likely to come, and you can play for that when the opportunity arises. But also be very clear on understanding order flow on the breaks, what you expect to see, and try for yourself to determine what looks like good order flow on a break, i.e. for continuation, and what doesn't. Because that way you're then going to be much more confident when it jumps up to decide whether it's got enough left in it to keep the move going, or whether it's jumped up and then rolled back or going to roll back over. And finally, be aware of the liquidation. If everyone's looking in one direction, the move back in the other can be just as violent, and that's the one that catches people out. And there's perhaps a little bit more edge in that because of the fact that people aren't looking for it. So it makes the trade a little bit easier to take on. You've just got to pinpoint where that turn and that liquidation pace is coming from.
If you find this video interesting, if you want to go deep into the Axia training method and how our trading team of 7-figure traders develop setups and strategies, and how they learn to build the most profitable trades across all market environments, then join me in this workshop. Now in this workshop, you're going to learn 3 powerful steps we use to train all our traders on both our London and our Poland trading desks to help build incredible levels of consistency. How to predictably understand which setups work and which don't. You're going to learn our 2 main strategies for how we perfect our trade timing before we enter every single trade. You're going to learn the VEL concept, which is our one and only technique we use to leverage our largest trades. You'll also learn how to avoid trading setups that don't work, how to avoid those large losses, and our main method we use to identify them that saves our traders significant amounts of capital. Finally, you will learn how our traders use the power of network learning to find market patterns quicker than ever before, so you shortcut that learning curve. In the workshop, we want to program your awareness of elite performance, to program your ability to choose the right setups, and program your ability to be a consistent trader. So the trades that you execute become more simple and clearer. And I can tell you this, you'll never see the markets the same again. You'll never look at the markets with a narrow view of getting lost in all the noise and confusion. You'll take your first step towards a deep edge market awareness. I cannot wait for you to join me in this workshop. And I think you're in for a massive paradigm shift in your understanding of how to develop as a trader. So join me by clicking on the top right-hand corner of the screen and sign up for this powerful training workshop, or visit elitetraderworkshop.com.